everything affecting the world today, it is not a children or grandchildren problem unless those children or grandchildren live in your flooded basement. You know, it's a problem that is affecting us right now. And I think maybe something these politicians could do is to make that case more strongly, to say, look, this is a problem right now. Look at your insurance rates going up. You know, if you want to talk about pocketbook issues, you know, so that could also help motivate more action right now.
Are there politicians elsewhere in the world who are managing this better? We've seen the face of green parties in various European countries, and think particularly about Germany, go up massively and then down. Are there politicians out there who are doing this in a different way? And Mark, just got about a minute left here.
Yeah, I wish I could say that there were some that were doing it much, much better. I mean, the political environment is different, obviously, in Europe and the UK. But the Labour Party in the UK, the Germans that you mentioned, they all have their issues, because some of these are American problems. I mentioned the Electoral College, but when you start to raise gas taxes to pay for other things in the economy, other things you want to do for clean energy or something like that, people revolt about that no matter where they are, France or anywhere. So it is a matter of making it clear that this is a now problem, and the now problem is also an economic problem. That fighting these things may cost some money now, but it's really an investment in avoiding bigger losses in the future and now.
And I highly recommend that everybody check out Mark's column, because it also, when you say the economic impact, we think it's, you know, constantly we talk about the emerging world, but you do make a point about the most developed world and how they will feel it maybe even sooner rather than later. Mark Ongloff, our go-to when it comes to things about certainly climate change and the environment. Mark is editor at Bloomberg Opinion, joining us in New York City. All right, that's going to do it for our first hour. For those watching on TV, the close is coming your way in just a moment. Stephen and I continuing on Business Week. We're going to get into question between lower mortgage rates or a stable jobs market in the U.S. That's tough.
You can only have one.
Not fair. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, everybody, we are just about 1 hour away from the closing bell on Wall Street on this Monday, September 23rd. I'm Carol Massar. Tim Stenivek is off for a few days, and with us is Stephen Carroll, host of Bloomberg Daybreak Asia. I'm thinking, like, what would be top of mind for you if you were getting things underway right now?
Well, hey, look, I'm still thinking about what happened this morning in poor PMI numbers out of Europe, but that is part of a big picture in the story that we're telling as we're looking at UN General Assembly Week this week as well, because we're thinking about the different narratives around economic data. PMI surveys the US today, not terrible, actually. Growth showing, not a slight tick down from the last month figures. But look, this is a picture that you're looking at. Very weak Europe. We're looking at issues in China. We're looking ahead to a press conference there tomorrow as well, on the question of where we're going to go next for the US economy.
It's really important. And on that, we're also thinking about that November election. It's just somebody in our makeup room was like, wait, it's 50-something days away? Like, it's just around the corner. We're going to get into the sectors most exposed to the U.S. elections. We teased a little bit about this idea that choosing between lower mortgage rates or stable jobs market. Talk about a difficult choice.
Yeah, sure is. And on that, we're going to be talking about the rate environment as well. Frank Sorrentino is going to be back with us as well, Chairman and CEO at Connect One Bancorp. So that's a conversation you're going to want to listen to as well.
I understand you actually, you're not an official lawyer.
Not a lawyer, no. Never passed a bar.
But you did study.
Okay.
Yeah. But how about a lawyer GBT?
This I think cool, right? Could be something extremely cool, but massive for the industry. If you can do some of the work that's the kind of finicky bits of trying to work out documents as well, and you can get AI to help you.
Yeah. How cool is that? Well. All right, we're going to get into that. We're also going to get into why the music industry needs to cooperate to grow. So it's all coming your way over the next couple of hours. Right now, though, let's get a check on the trading day. Let's toss things over once again to Charlie Powell.
All right, thank you very much indeed. 59 minutes to go. Steve and Carol Massar until that closing bell. S&P right now, right to the numbers. Green on the screen here. Stock market advance. S&P up 13, up 0.2%. We've got the Dow up 48 now, up by about 0.1%. And the NASDAQ Composite Index up 33, up now by about 0.2%. Equities eking out a gain. Bond yields are steadying. We have got the 10-year 3.74%, the 2-year 3.57%. Gold up $5 the ounce, 26.27 right now, up by about 0.2%. And West Texas Intermediate crude 70.37 a barrel, down now by about 0.9%. As for the economic backdrop and the Federal Reserve, Liz Young Thomas is head of investment strategy at social finance SoFi.
My concern is that we've hit this point in the economy where we're very balanced right now. Things look good right now. The consumer is still healthy. The labor market is balanced. Inflation readings have come down. Things feel good right now. We are not overheating. But my concern is that we're just making a pit stop in this balanced level on our way to weak.
Liz Young Thomas of SoFi interviewed this morning on surveillance. And you can hear more of the conversation on the Surveillance podcast. Download it wherever you get your podcast. Boeing has sweetened a contract offer for about 33,000 workers at its main Seattle manufacturing hub, seeking to overcome a strike that has been going on for more than a week and threatens to deepen the plane maker's financial crisis. We've got Boeing shares advancing now by 2.2%. Again, recapping, stocks higher, S&P up 13, up 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I'm Carol Massar along with Stephen Carroll. He's host of Daybreak Europe. I gave you another title.
I mean,
I could do it all.
Yeah, exactly. I'm just going to stay up 24 hours a day.
We just go around the clock. All right, let's, speaking of the clock is ticking on the November elections here in the United States. The latest polls in the U.S. presidential race show Donald Trump ahead in Arizona, key state, leading in Georgia, also an important state, as well as North Carolina. Those numbers coming, Stephen, from the New York Times and Siena College.
Yeah, look, with a race this close, Bloomberg Intelligence has been looking at the 6 sectors to watch for exposure to the outcome of November's election. And joining us to discuss from Washington, D.C., Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. Nathan, great to have you with us. Give us, first of all, the big picture from your research to start with. Is this a risk or an opportunity for the sectors involved?
Well, it can be either, because for every risk, there's also an opportunity. But, looking at some of the sectors like banks, for example, the investment banks. Well, if Kamala Harris, the vice president, wins, more likely than not, the Basel III endgame moves forward next year. This is a proposal coming from the Fed that raises capital requirements 9%. If President Trump wins, it's indefinitely delayed. Think of electric vehicles. If President Trump wins, well, there could be some risk there that electric vehicle tax credits could be chopped away. If Vice President Harris wins, obviously those EV tax credits are most likely cemented. But for every policy that we look at in every sector and so forth, it's always important to remember, A, can this get through Congress? Can this get through via regulation? Or can this get through executive order?
Right.
And B, there's always a risk or an opportunity for that result.
Well, it's funny, right? The down ballot races are so important, and we talk about that a lot. As important, obviously, is who's in the White House, but whatever kind of Congress will determine whether or not a president can get certain initiatives passed and get done. Having said that, when you talk about the EV market, it was interesting what you said, but I think about the friendship that seems to be between Donald Trump and Elon Musk, and so I do wonder that even though there might be pushback, or so it seems, you do wonder whether Trump, if he's back in the White House, might be like, all right, Elon, you're kind of my buddy. Maybe I'm going to be easier on you. Like, you do wonder the twists and turns that we've seen in the past of a Trump administration. Might that still play out?
Yeah, absolutely. I mean, that's one of the things, it's one of the biggest questions we get is the Elon Musk factor. But, I was talking to Steve Mann, our autos analyst based down in Princeton, and one of his takes is that Tesla's in a position where, they're a market share, leader in this space. And if the EV tax credit goes away, they still may be somewhat okay in terms of high net worth individuals paying for Tesla manufactured cars. If you look at Ford and GM, on the other hand, they already have productions in terms of plans of smaller, cheaper EVs, so that maybe this tax credit, if it goes away, they're still prepared. But this is the big question with the President Trump, presidency, and this would also apply to big tech, is this idea of economic populism that's coming from the Senator J.D. Vance wing of the Republican Party. You can't go back to the days of old where, at a high level assumption, Republicans equal good for big business. And so if you have this economic populism coming into the White House, it could be very tough for one of our sectors, big tech, where there's going to be a lot of scrutiny over antitrust and probably a lot of scrutiny on the regulatory side as well.
Yeah, I do find that question fascinating because the idea that you can't really tell which candidate is going to be better for big tech because you're worried about where antitrust goes from here seems crazy at this point when we're this close to polling day.
Yeah, absolutely. You know, just going back to Senator Vance, he came to the Bloomberg Bureau in Washington, D.C. this summer and called Lena Khan, President Biden's Federal Trade Commission chairwoman, one of the best things that President Biden did, and even insinuated that President Trump, if elected, could keep her on. Now, I don't think that's going to be the case, but that gives you an indication that, you know, this is very much a different Republican and Democratic environment that what we have. So it always is important, though, to go back, though, and remember how things get done in Washington. If President Trump or Vice President Kamala Harris says, I want to do something via legislation, legislation's hard to come by. If they want to do it via regulation, sure, you can avoid Congress, but the courts are becoming more skeptical on it. And if it's via executive order, always remember, most of the time, it's a fancy way of the president picking up the phone and directing his or her staff to do something to either the legislative or the regulatory side. The other part of that is tariffs and trade, where the presidency, the power of the presidency is more powerful. And so the tariff argument is something that we'll probably see under both presidencies, but just to a different scale.
I am curious, too, what you're thinking about tax policy in general. I was reading something over the weekend. I don't know whether it was the New York Times. Matt Miller and I were kind of sending articles back and forth. But this whole idea of, maybe, Donald Trump is increasingly moving towards no income tax and moving more to some of the models that we see overseas. And then where do we make it up? Is it kind of a value added or a consumption tax? And I do wonder if any of that is gaining any kind of merit as you guys look at different sectors.
Yeah, so there's two things to keep in mind when it comes to the tax argument. Now, that is going to be in the second half of 2025 because the individual tax cuts expire. Now, if President Trump wins the House and the Senate, he gets a majority in both chambers, he can use reconciliation, and he can have a very broad pen and do a lot of the things that he wants to implement. Corporate tax rate potentially down to 15%, SALT deduction may go away again, so there's a lot of broad things. But if the Democrats take the House, it has to be more nuanced and it has to be more negotiated. And I will say that those individual tax cuts that expire in 2025 is extremely expensive. And so you're going to have to figure out how you're going to pay for it. And a lot of people have been talking about maybe they're going to get the IRA, the Inflation Reduction Act, as a way to pay for it. The IRA doesn't even come close to paying for those individual tax cuts. So even though there's a lot of plans on the horizon, and President Trump and both Vice President Harris say they want to do a lot of things, the wonks, the nerds over at the House of Representatives next year are going to really have to try and figure out how to pay for it, because that's going to be an extreme challenge unless they just, so we're going to have to wait and see what happens next year.
I'm sure those nerds are pleased that you've just given them a shout out for that as well. I did have a quick question on healthcare though as well, because that's another cliff edge moment, because there are subsidies there under Obamacare also due to expire. What's the reading from the sector? How worried are they on that?
So, they're not very worried if Vice President Kamala Harris wins. There's this idea that it will be cemented if she does win and that they'll be able to extend them, because it's something that the Democrats have been pushing for the last couple of years. The question, though, is if President Trump wins. So if President Trump wins, this idea of subsidies is not something that, really is something that's flowing through the Republican Party at the moment. But as we saw in President Trump's first term, they tried to do away with Obamacare. And if you remember John McCain's famous thumbs down vote, they struggled to do that. And so, when it comes to healthcare policy, it's going to get into the weeds, I think, in the latter half of next year, because I don't think either president is really pushing broad changes at this moment. It's going to really be driven by the House and the Senate and so forth. And so I think if you get this Harris presidency, you're somewhat safe. If you're a Trump presidency and you're looking at this from an opportunity or risk, you're going to have to pay attention to it.
Interesting stuff, as always. Hey, Nathan, thank you so much. Bloomberg Intelligence Senior Policy Analyst Nathan Dean joining us there from Washington, D.C. All right, that's our check kind of on markets and U.S. politics, where it might go. Let's get to the choice we may have to make when it comes to the U.S. economy. I got to say, not an easy one.
No, and it's not just picking who to vote for in November either. No. This is the choice between lower mortgage rates or a stable U.S. job market. Writing about that in a Bloomberg Opinion column today, columnist Connor Sen, who's also founder of the financial advisory firm Peachtree Creek Investments, which has $33 million in assets under management. Connor joins us from Atlanta. Great to have you with us, Connor, for this as well. Why a choice?
Well, I think a lot of people are looking at the Fed cutting rates last week and are saying, how low can mortgage rates go? They're finally coming down. The Fed is finally cutting. But my column laid out that markets in the Fed currently believe that the Fed funds rate will get down to about 3% and no lower. And so arguably that's now priced into markets. And mortgage rates currently are in the low sixes. There's room for mortgage spreads to compress. Maybe mortgage rates can get into the high fives. But unless you see a pretty significant worsening in the labor market, we're getting pretty close to the end of mortgage rates falling rather than the beginning.
So in other words, if we're going to see even lower mortgage rates or the Fed having to be more aggressive, it's going to be because the job market's starting to fall apart and that whole idea of a soft landing maybe not actually so soft.
Exactly. So what we've seen over the past 3 to 6 months is that markets went from this higher for longer stance to seeing the softening in the labor market, seeing inflation normalizing, believing that the Fed is going to cut. And we've kind of just gotten there. And we've seen the mortgage rates have actually risen since the Fed meeting last week. They rose to 6.2% today, which is kind of where they were 2 weeks ago. So again, if you're hoping for rates to fall into certainly the threes or fours, that's just not on the table, barring something in the labor market that we currently don't see.
Who does this fall on worst? I mean, is this a kind of, are you going to see this essentially affecting people who are in the weaker end of the labour market, who are going to be facing more of the flexibility on jobs? Or, is this a question that homeowners, at the lower end are going to be worried about too?
Well, I think people who bought homes over the past 2.5 years can get some refinancing relief. So that's good news for them. Maybe not as much as they want, but some. And similarly for first-time buyers who have felt locked out by 7 or 8% mortgage rates, we can probably get into the high fives, 5.75, something like that over the next 6 months from spread compression. But for people with maybe 3% mortgage rates who are looking to move, maybe 5 3/4 isn't quite low enough for them to make the switch. So they're going to feel trapped for a while longer. And similarly, just because affordability remains such a challenge, if there are people who need even lower rates to afford their first home, they might not get the relief they need.
I also wonder, Connor, and you get into this in your story. I have a family member who's been involved in the mortgage business, who was crazy during the pandemic. Like, it was hard to even catch her. She was so busy around the clock because people were buying homes and moving around a lot. Having said that, that kind of supply chain, that infrastructure, when it does pick up, is it not quite there yet because it's slowed down so much?
Yeah, I mean, a lot of banks have either pulled out of the mortgage market, or non-bank lenders which aren't great companies in a lot of cases, have really slashed costs to the bone just to try to make a dollar waiting for this market to turn around. So I think people look at mortgage rates and think, well, if rates got to a certain level, I can just pick up the phone and someone's going to answer my call. Well, a lot of those people have left the system over the past 2 years, and they might not be around. And staffing up might be a multi-month process, kind of like the supply chain challenges we saw throughout the economy 2-3 years ago. So that would be a point of pain if mortgage rates actually did fall more than people expect, and then they can't get people on the phone to deal with their paperwork for a while.
Talk us through the timeline here. Where's the pinch point coming? Where do we need to be looking forward to?
Well, I think for now, whenever you're talking about housing, it's really about what does next spring's housing market look like, spring housing season. And down here in Atlanta, that's really kind of a mid to late February thing. In the Northeast, it might be more like March or April. But that's only 5 months away. And so, again, the Fed looks like they're going to signal cutting 25 basis points at each of the next 2 meetings. There's room for some spread compression over the next 3 to 6 months. I think you can get mortgage rates into the high fives, but something much lower than that is going to take a real, falling apart of the labor market, which it doesn't seem like that's on the table, at least for the next 6 months.
Yeah,
so I think if you're looking to transact in the housing market next spring, high fives is where you should think.
Yeah, I think at some point, right, and I'm curious about the narrative around it, because it was interesting. I was at an event, Future Proof, out on the West Coast earlier last week, and it felt like everybody was actually pulling back. This was ahead of the Fed meeting and ahead of that 50 basis point cut, but people pulling back kind of their expectations of what the Fed was ultimately going to do maybe this year and even into 2025. It reminded me of kind of late last year, a year ago, coming into 2024 when everybody was so aggressive, and then that all pulled back. I am curious, you guys, you are involved in financial advisory. What are you hearing? Are investors looking to put money to work? Are they still cautious? What are you hearing about all of this?
I think a lot of people are on hold until the election. That's an obvious reason just to hold off. And then with the Fed beginning a rate cut cycle, even if a lot of it's priced just because the novelty of a 50 basis point cut and not really sure what the Fed's going to do, it's just a pretty easy thing to say, I'll wait until early next year, see where things are, and then we'll go from there. And I think a lot of probably hiring managers and corporations are in the same spot.
Okay, Connor, thanks so much for joining us. Connor Sen there, Bloomberg opinion columnist and also founder of Peachtree Creek Investments. You can read Connor's piece on Bloomberg.com and on the terminal as well. We either get 4% mortgage rates or a stable job market.
I think
what a choice.
Yeah, exactly. But I do think he makes a really good point that, let's get through the elections. Maybe let's get through the end of the year. Let's see how things settle in, right, in terms of economic data points, and we'll get a clearer picture of what the Fed might do.
Sure, but that spring housing season not far away. Also did not know that was a thing.
Well, it's a big thing here, and especially if you have kids. Like, you think about, okay, you want to move maybe like in the springtime, get it so the kids can finish up their school year, move late spring, early summer, so that they are set up for a new school, especially if you go into a new school district. So there is some reason.
Thank you for explaining that to me. See, we're all here to learn something today.
That's part of it. All right, everybody, we're going to continue here on Bloomberg Business Week. Carol Massar along with Stephen Carroll. Coming up, we're going to see what our next guest has to say about that choice of lower mortgage rates and a stable job market, what Fed rate cuts mean at Connect One Bank. It's a guest that we've often turned to when it comes to Fed rate moves and what's going on in the banking community. The CEO of Connect One Bank, Frank Sorrentino, stopping by right here on Business Week.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We got 39 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ, all in the green right now. 14-point advance on the S&P. We are now at 57.16, up by about 0.2%. The Dow pushing higher, up 54 now, up 0.1%. While NASDAQ is up 32 for the NASDAQ Composite Index. That's a gain now of just about 0.2%. 10-year at 3.74% with a 2-year that's yielding 3.57%. Gold now higher by $5 the ounce, 26.26 on the precious metal, up 0.2%. And West Texas Intermediate crude down 0.8%, 70.43 for a barrel of WTI. Equities paired gains. Treasury yields fell as traders combed through commentary from Fed policymakers for clues about the outlook for further easing. As for the market backdrop and the Fed, Dana Dioria is co-chief investment officer at Investnet.
I think they're playing a little bit of catch-up. They do expect another 50 by the end of the year. The market seems pretty settled on that, which is kind of nice, right? Because clarity can help with market volatility. And I think the bull case is certainly, the base case, but I do expect a lot of volatility throughout the course of the rest of this year.
Dana Dioria interviewed this morning on Bloomberg Open Interest on Bloomberg Television. Oil lower after a weak outlook for fuel demand and the potential for the conflict between Iran and Israel to de-escalate after its recent flare-up. As I mentioned, crude oil down now by about 0.8%. As for oil stocks, so today they're trading higher. Case in point, ExxonMobil up 1.5%. ADRs of BP, they're up 0.4%. Chevron up by 0.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Well, bank stocks have rallied nearly 3% since last Wednesday, following the Fed's half-a-point rate cut, since dropping back more than 1%. Back with us, though, to talk about what's going on when it comes to rate cuts and the impact on the banking community is, once again, welcome to have with us Frank Sorrentino. He's chairman and CEO at Connect One Bancorp. It is the publicly held New Jersey-based community bank. They've got roughly a $962 million market cap. Since we talked, Connect One expanded its reach into Long Island thanks to a merger with the First of Long Island Corporation. As for shares of Connect One overall, they're up nearly 10% year to date. They've rallied about 45% since mid-June. Frank, so great to have you back with us here on Bloomberg Business Week. How are you?
Thank you, Carol. We're doing quite well, and thank you for having me back on the program.
You bet.
Great times.
You've been busy. Tell us about this deal, this tie-up. You didn't actually give us a clue, but you were spending a fair amount of time in Long Island. But go ahead.
Well, we've been working on Long Island for the last 5 years, and this is a really great market adjacency with a company that has a very similar culture and an incredibly attractive client base. So we're really excited to merge together with these folks. It's a great team of people, and we're looking forward to giving that First of Long Island, as well as all of their clients, a great experience on Long Island with some more capabilities, some more products, and some more services.
Hey, Frank, I'm sure the people of Long Island would be thrilled to hear you describe them as being incredibly attractive as well. So we'll take that for them too. But look, are you looking at any other incredibly attractive places for perhaps some more acquisitions?
Well, I think we've always said that we're opportunistic as it relates to M&A. It's been 5 years since the last transaction that we've done, and I think our organic growth story is also something to talk about. We've grown quite a bit organically, and when there are good opportunities in sound and really interesting markets like Long Island, and there's the opportunity to do something with a partner that we feel makes sense, we will seize that opportunity. So. Our growth has been a combination of both organic and M&A.
Let's take a step back and look at the big picture here for a minute about where the kind of broader situation is after we've seen the Fed cutting rates last week as well. How much do you feel like there is a clear path ahead for what happens next, and how are you thinking about it in terms of your business and the future rate environment?
Well, I think the Fed has made it very clear that they have a series of targets ahead of them that they want to achieve. Whether they achieve them, in a shorter time frame or a slightly longer time frame, I don't really think matters all that much. So whether the next cut is 25 or 50, or whether they skip one, or whatever they do, but the fact remains they're clearly on a track to get to lower rates, probably somewhat another 100 or 125 basis points lower, probably by year end, and that they have a definite target in mind for where they want the economy to go based on the data that they see today. If that data changes, they may change those targets.
How do you feel about the economy? You've been on with us a lot over the last year. You've often, I repeat myself, but when people were talking kind of dour about the economic outlook, talking recession, you were talking about robust was the word you often used when it comes to what's going on in the U.S. economy. Tell us about what you are seeing, and does it maybe mean the Fed doesn't need to go 125 basis points because things are going really well?
Look, I think we are still in a robust economy, and I think the Fed has gotten it right to lead us through to a soft landing. This was a mission, and it was a mission that many people had in doubt that they could ever achieve, but yet here we are. The economy is doing well. Business formations are at an all-time high, no matter how you look at that data, and I think that bodes very, very well. Home construction is going gangbusters, and that bodes well for the economy,
you
right?
play into residential, right? And you play into because we talk about it. Is it still going gangbusters?
It is, well, again, we're talking about the market areas that Connect One Bank serves, right? Yeah. So the New York metro market is very constrained as it relates to housing. And so every construction project that we're involved with, when it's completed, whether it's homes, condos, townhomes, they are sold. Whether it's apartments, they are being rented, and generally at higher than pro forma numbers. So that bodes well for the economy. And keep in mind, I've always been a big proponent of home building, whether it's for apartments or for people to own houses. When people move in someplace, they buy stuff, right? They buy a lot of stuff. It is one of the greatest generators for, in the economy that exists. And so when you see, home building going at a rapid pace, and you see people buying homes as fast as they can get them, there are bidding wars going on for existing home product today. There's just not enough. You speak to any realtor, they will tell you there's just not enough product on the marketplace. That tells me things are pretty good. People have jobs. People have the income to support, their lifestyles and those apartments and those homes. So again, the reason I say robust is because I feel people have great jobs and are continuing to spend. And that's what our economy is based on.
We are seeing a very slight loosening happening in the labour market now, though, and I wonder how you're thinking about that in 6 months or a year's time. And as you're issuing all these loans, these people are out there enthusiastically buying homes in the area as well. How are you concerned? How are you testing with these new borrowers also to see how much they would be able to withstand should the labour market take a bigger downturn?
Yeah, I don't see the labor market taking a big downturn. We have to keep things in relative perspective, right? When you think about the labor market with a 3.5% unemployment rate, 5 years ago or 7 years ago, you would have told me that's impossible. We can't get there. The neutral rate or the stable rate was 4.5% or 5%. So I think we're coming off an incredibly strong economy, and maybe it's slowing a bit, but it's not faltering. Companies are still complaining that they can't find or source really good talent today, and so the opportunities are still there for folks and people who are in the places in the economy where there's a need for certain types of labor, certain types of services. They just can't find enough folks to fill those positions. So and I'm not sure that 4% unemployment is something where we should be worried.
Well, and one of the things, we just had a discussion with our Connor Sen. He founded a financial advisory firm, but he wrote a Bloomberg opinion column that basically saying, Frank, that we're going to have to kind of make the decision between either having lower mortgage rates, which some would like in a big way, or we're going to have to let the Fed kind of, maybe allow for a stable labor market. Like we just kind of can't have both. Like if you see the Fed cutting rates even more, which would bring down mortgage rates even more, it probably means because the economy is coming undone and the labor market is coming undone. So how do you see it? Is the Fed going to have to kind of make some choices? Are we going to have to make some choices about what we get with this U.S. economy and want?
I think the Fed is making choices, and I've been a staunch proponent of the Fed's actions over the last number of years. I think they've gotten it right. Could they have been a little bit faster on the uptake? Could they be a little bit slower maybe here, or maybe they need to go a little faster? I don't know, but overall, I think they've been doing a good job. Here we are, we're sitting in an economy with very, very low unemployment, and we're sitting in an economy that is growing, where consumers continue to spend. So I think they're getting it right. If anyone is thinking we're going back to a time when we're going to have 3% mortgages, okay, that's not going to happen. Mm-hmm. But the idea that we're going to have, 4.5%, 5%, 5.5% mortgages, that's nirvana if you think about any other time period in our history. So we're not that far away from that, and yet still have low unemployment and still have a growing economy with all the opportunities we have. The U.S. leads the world in so many different industries. What else could you be wishing for? This is a good place to be. And I think the Fed is getting it right. And I think we're going to land in the right place.
Okay, I'm hearing all of the optimistic messages, and I appreciate them, and I hear you. But I do want to ask you if there's anything you're worried about, because, there are concerns out there. And I'm just
talked to a lot of American voters. They certainly feel that way.
And I'm just curious as to what you're watching for the potential signs that maybe things might, there could be some bumps in the road on the way.
There's always the potential for bumps in the road, and we counsel all of our clients to, be aware, have situational awareness. Could there be a spike in, various indicators? There could be a change in interest rate policy that was unexpected, right? 6 months ago, everyone thought maybe rates were going to go up. So I think it's important for people to prepare for a number of different eventualities.
That happens, Welcome to the world.
People should,
there you go.
And people should not, necessarily make business decisions only based on headlines that are in the news. We should take a look at what's going on the ground. What I am speaking to is what our clients are telling us about their business prospects and where they're willing to invest their capital. And the things we're being told is that it looks like the economy is on a very solid footing as we sit here today, and will continue to grow moving forward.
Hey, 30 seconds. So when you look at your loan book or when you look at loan demand, you don't see any signs of stress?
Look, there's always signs of some sort of stress somewhere in the economy, and it moves from place to place. So yes, we always have to keep an eye on that. And the lowering of interest rates is making some of those areas better off today than they were maybe 6 months ago, but it may create other issues in other places. Anyone who's lending money has to always, be attuned to what parts of the economy are moving better than others. And that's a very, very, fast moving environment. So I wouldn't say it's devoid of any stress whatsoever. We certainly, that's our job, is to look at where those things are occurring.
Well, as you know, we always appreciate when we get some time with you. Frank, be well. Frank Sorrentino, he's chairman and CEO at Connect One Bancorp, joining us there from Long Island. All right, we're going to be driving to the close, kind of bouncing around. We're definitely off our highs of this session, just a little bit higher, though, on those major U.S. equity averages. Coming up next, we've got someone who's cautious for the rest of the year, already thinking about risk opportunities in 2025, that new year just around the bend.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks higher across the board. The Dow, the S&P, NASDAQ, all advancing. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are posting modest gains right now, with the Dow currently up 55 points. S&Ps are higher by 15 points, and NASDAQ rises by 0.2%. The U.S. 10-year yield of 3.74%. Gold is a little changed. Oil trading in the red, and Bitcoin, that's higher by 0.4%. Among the main 11 S&P sectors, only tech and healthcare were in the red, and leaders to the upside in the Dow, Intel and Boeing, while Salesforce and Merck each fell 1% and led to the downside. Regarding Boeing, the stock spiked intraday on a report they have raised their offer to the union. And in other news, the Fed's Goolsbee sees many more rate cuts over the next year. Wrapping things up, AAR Corp reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type SQUA, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody. Just under 20 minutes left in the Monday trading day. You heard Charlie breaking down the numbers, Bill Maloney as well. And we're definitely off our best levels of the session. So I'm going to say, Stephen, just a little bit higher. But, it was a big week last week with the Fed meeting. I feel like we're going to wait to see what Fed speakers are saying, although a lot have been out in full force.
Yeah, that's true. We heard from Austin Goolsbee, among others, talking about many more rate cuts expected over the next year or
What
two.
does many more mean? Is that
It was
10 or
sufficiently
20?
nebulous, is what I enjoyed. I think you probably needed to hear him say it to really understand what he
Exactly.
meant when we're thinking about the year ahead. Let's bring in Veronica Willis, as Global Investment Strategist at Wells Fargo Investment Institute. She joins us from St. Louis. Veronica, great to have you with us on the program. So, what's your reading on where markets are this week, right? Are we in a sweet spot? We got the 50 basis points. We haven't gotten into earnings season yet. Is this sort of a happy coasting moment, or do we need to watch out for icebergs?
I think we're in a bit of a sweet spot right now. A pretty quiet day that we've seen today after a very eventful week last week. But I think ahead, we've got some important data this week. Most importantly, we've got that PCE inflation expected on Friday. And while, markets have shifted their focus a little bit to the labor market over inflation, I do think those inflation updates are going to continue to be important.
Yeah, I agree with you. We are so still data dependent. I mean, folks, if you thought we were over it, we are just so not. It's data dependent. And inflation, and even the Fed said, right, Veronica, made some point about that inflation's still not quite where the Fed would like it to be. So that they are watching as well.
Yeah, absolutely. A lot of people have taken 50 basis point cut by the Fed as a win over inflation. And I think what's going to be important for all of the various Fed speakers we've got this week, looking at what they're saying about inflation. They certainly haven't told us, we have a victory over inflation. They still want to see that inflation number come down some more.
On the soft landing question, we were speaking to the CEO of Bancorp there a moment ago.
Connect One Bancorp,
thank you. Super optimistic about where things are going for the U.S. economy. But this question of soft landing and the risks to that landing still in question. I mean, what's the market perception on that from your point of view?
I think the market is becoming a little bit more concerned that maybe there will be a recession, but I think soft landing is what's priced in, and that's what the most likely scenario is. We're seeing
Is soft landing
economic
right,
growth
though,
slow
based
down.
on what you guys look at?
Yeah, I think we're seeing slowing economic growth, but not enough to put us into a recession. And I think by the time we get to that low in the growth, we'll start to see that acceleration and really avoid a recession at this point.
When we're thinking about next year, the idea of there being a better economic picture in play there as well, how do you position now to be ready for that next year?
I think for now, we are a little bit cautious thinking of U.S. large caps over small caps. And then in the fixed income space, we like investment grade over high yield, waiting for a little bit of a better entry point to making a shift to those risk on. So once we start to feel a little bit more comfortable that the economy is starting to accelerate, that's when we want to make more of a shift to those more risk on areas of the market that tend to do well as the economy starts to reaccelerate.
All right, so for people who are putting new money to work right now, what's your advice for people who have existing portfolios? What's the tinkering you suggest right now?
I think right now, a focus on the U.S. large cap space. We've seen a bit of a rally here, so I'd focus on some of those sectors that have the best valuations right now that we're expecting to do well over the next 12 to 18 months or so. So we like communication services, financials, energy, materials, and industrials. We think that those sectors are, a little bit better valuation than tech, which has gotten a little bit overextended over the past couple of years, but should also benefit from the long-term type of AI trends that has really boosted tech. I think sometimes people forget that other sectors will really benefit from that AI trade, and that's what I would really encourage investors to do right now.
Communication services as a whole, certainly a group that we talk about a lot. It's a little bit lower in today's trade. If I bring up the year-to-date numbers, let me just go there. On the Bloomberg, you see communication services up almost 26% so far this year. It's an interesting group, though. You've got your media names, your traditional media companies, but you have something like Meta in there. You have Google in there. So I know you can't necessarily talk specific names, but when you drill down into various sectors within communication services, is it some of the mega cap tech names that you guys still find interesting, or is it some of the traditional, is it the streamers? Like, what is it?
I think overall as a sector, we really like the opportunities there. We do think some of the mega caps can still perform well as long as their earnings still deliver what the market is expecting. We've seen a little bit of market broadening this year with other names participating in the rally and not just that heavy concentration on those, top 7 stocks or so. And I think that's what we're expecting to continue for the rest of this year and into 2025. So I still think that there's room for communication services to improve, and adding that exposure on days when you see pullbacks is a really good idea.
What about companies that are consumer focused? I wonder what's your reading on the U.S. consumer right now. We've had the first rate cut. That's going to help those that have mortgages to pay. But more broadly, there have been signs of weakness in some of the data.
Yeah, and we're really seeing that consumer confidence also wane a little bit as, consumers are just they're really worried about inflation. They're really worried about where prices are now. And we haven't necessarily seen that flow through to retail sales, which have held up okay. It's softening a little bit, but it hasn't gotten to a concerning point, which is part of the reason why we're in that soft landing camp. We'll think the consumer will be able to hold up okay. Not as strong as they have been previously, but that's a big portion of why we're expecting economic growth to slow but not pull us into a recession, is just that the consumer should hold up okay.
Is the AI trade still a good one in your view?
I think it's important to think of the AI trade as more than just a near-term type of play. It's a longer-term theme, which I think will play out in the markets over years to come. And so I do think it's important to think outside of the tech sector when you're thinking of that AI play. That's not the only place where you'll really be able to see the benefits there. In particular, the energy, materials, industrial sectors will also benefit in the AI because they're all part of getting up to those AI solutions. Mm-hmm. And right now they have a little bit better valuations than what we're seeing in the tech sector. So that's a really great way to play that longer term AI trend.
All right, going to leave it on that note. Listen, Veronica, we really appreciate your time today. By the way, NVIDIA's up about 0.4%, in case you were curious. I feel like we say AI, we have to talk about NVIDIA.
That's Veronica Willis there, Global Investment Strategist at Wells Fargo Investment Institute, with us from St. Louis. And actually, the AI story, a good point to pick up on, in a conversation we're going to have a little bit later in the program as well, because we're going to be talking about AI in law. We've got Eleanor Lightbody joining us. She's the CEO at Luminance, and they've developed a large language model for the legal sector. They've recently completed a fundraising round. They're expecting expanding
makes
as well.
sense to me.
Yes, me too. I want to
Right?
know more. Lawyer GPT, it's coming. This is what we're going to be talking about coming up with the program.
All right, don't go anywhere. We're soon going to head over to our TV colleagues, count you down to the close on this Monday, September 23rd. I'm Carol Massar along with Stephen Carroll, and this is Bloomberg.
listening to Bloomberg Business Week with Carol Massar and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, just got about 7 minutes left, 6.5 if you want to be exact. You know, I do have a clock in front of me. Date is kind of important to me. I should get it exactly. We're going to head over to our TV colleagues in just a moment and count you down to the closing bell on this Monday. It's kind of an interesting day. It's kind of a little mellow, I feel like, and even searching for stories. We did a lot of macro chat today because it just feels like we're taking a little bit of a breather.
We sure did. And look, we had that story from Boeing come through during the show as well about this last and final offer for pay rises as well. 30% general wage increase to the union. That's something that's moving the stock today up 1.8%, is moving towards the close there too. And look, this is amid, there's a whole load of companies as well who are out there doing their wage deals at the moment. It's making for a lot of very interesting headlines because, of course, we're thinking about what it means for the bottom line afterwards.
Well, you know, and it's when you get caught up in the macro and, you know, in some ways, it's a reminder. Boeing's got obviously a full plate of issues that it's been dealing with. That's why the stock is down so much this year. But the strike was another issue that was layered on. And so the sooner they can get done with it, that's a good thing for that company as they figure their way forward, you know, under a new CEO and just trying to figure it out. Boeing shares are up 1.8%. But I even think about the conversation we had with the CEO of Connect One Bancorp, Frank Sorrentino. I mean, he just did a deal a few months ago. And so taking on more assets, expanding his footprint, you know, I do think that is a positive sign when companies can do things, whether it's a deal, make investments. It's an important thing.
And not seeing stress among his borrowers either. I mean, this is the other part of it too. Rates are coming down, but they're still high. So people who are going to be feeling squeezed, and we've seen that in some of the data around things like credit card defaults in the recent weeks too. The Beige Book also gave us a couple of signs of flags to be worried about. Didn't quite reach the level I think what Frank Scatino was going to be worried about, but this is something.
Been pretty optimistic for a long time.
And you know, it makes sense why. He talks to us about how hot the property market is in the New York metro area. That's a key part for their business too, with their expansion into Long Island. So, I mean, a lot of that makes sense when you think about it, but there are still questions over how durable this is, how much people are going to feel squeezed. We know that it's a political conversation being had in the election campaign, that people are finding it tough with a lot of this too, and this is going to feed into the conversation too.
Right, and certainly who ends up in the White House, right, in terms of the types of policies you see going forward. Having said that, we did talk about rates, we talked about mortgages. We do have new home sales data later this week. We have existing home sales data, and we also do get core PCE, right? And so, listen, which is how I love Fed meetings. I love the decision. I love the excitement. I know
you're over it now. Is that what you're telling me?
Well, what I'm saying is that, you know, we go through all the expectations and everybody, you know, weighing in, and then we get the decision and we parse through every word, and then of course you have the press conference. But I do feel like when all is said and done, ultimately, yes, we get, you know, an indication of where the Fed is, and we did get finally a rate cut. But when it comes down to it, the Fed's going to watch the data points. That's going to determine what kind of future policy, Fed policy we have. And that's just kind of what central bankers do, right?
Yeah, I mean, look, and it's something that we saw. We had the PMI numbers out for U.S. services today. That was kind of an interesting one to watch. It came down a little bit from month to month.
Do you talk as much about rate policy like when you're doing your shows?
Oh, yeah.
Yeah, right?
But we do, and we've got several to watch. Like even there's a Swedish central bank decision happening this week as well. There's a Swiss one coming too. Like we've a couple of others.
Headlines,
exactly. Yeah. But we're worrying about, you know, in my regular job in London, we're worried about, of course, the Fed, but we're also thinking about the ECB, and that's been such an interesting journey, by the way, because telegraphing rate cuts, I mean, that they said very clearly what they were going to do. They did it. There has been no surprises.
And there's no dual mandate, is there?
No. So people will watch people will write books about this moment for the ECB as well, because, you know, a relatively short history of a central bank and trying to figure out how they've managed to cope with each of their various crises.
I think it's a tough mandate. Like that is a tough mandate.
Well, it's also you're dealing with 20 different countries with different economies.
Right,
you know,
exactly. Yeah,
making things all the more difficult.
It makes it really, really difficult. So it's an interesting kind of day. We're going to talk a lot about climate tomorrow from a special broadcast that we're going to be doing here at Bloomberg. But I do feel like it's day to day, and we'll see as companies, you know, whether we haven't had a lot of headlines about companies, at least here in the United States, letting go of workers. We still talk about labor hoarding.
Yeah.
You guys?
I mean, yeah, it's a pretty similar situation. We're starting to see loosening in labor markets, but not massive for the moment.
Yeah.
And the question, of course, is that, you know, we're heading into earnings season. How much are we going to hear about that coming up as well?
All right, guys, we're going to head over to our TV colleagues. Count you down to the close. We've got a market bouncing around, but a little bit higher on the S&P and the Dow. But time to head over to our TV team. That's because the closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And we're 2 minutes away from the end of the trading day. Alex Steele here with Sonali Basak in for Romain Bostic here to help us go through the closing bell. We've got two global simulcasts, Carol Massar and Stephen Carroll. They sent him over from London because that's how awesome he is. In for Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day, Carol.
You guys have worked together, haven't you?
Yeah, we did a show once. It was great. She never invited me back afterwards. So.
Wait, that's not fair. They tell me what to do.
This is the first time we're meeting on air. Hello and welcome.
We're in the same building this time, you know. This is much easier than doing it between London and New York.
It's amazing what we can do. Having said that, it does feel like, you guys, a quiet day today, and maybe we're just all exhausted from all the news last week. I'm already thinking about the inflation print that we get here in the U.S. later in the week, Stephen.
Yeah, I mean, hey, look, if ever we think that we're over talking about central banks, there's something else comes up, and we're looking at a PCE, of course, later this week as well. We did have some PMIs out earlier today for the U.S. showing a slight slowdown, but still an expansion territory. So the next focus will be core PCE.
I've also been interested in the steady climb in the tech and AI stocks as well. For all those valuation concerns, you have a market that's shaking it off, along with all the worries along with it.
Yep, and also if you take a look at the divergence of the different sectors, for example, we were talking earlier about how you had net short future positioning within the S&P, with the S&P mini futures, right? And you can see also on the Russell, on the other hand, you have super solid positioning for that. And I should point out the Russell's down 0.3%, outperforming mid caps, guys. Very interesting when you take a look at that market. The VIX, though, going nowhere as we head into these closing bells here. There you go. We're looking at a VIX at 15. Nothing to write home about, as Carol was just saying. The S&P, we're settling out here, but closing out by about 0.3%, around the highs of the section. The NASDAQ up by 0.1, and the Dow up by 0.1%, Carol.
All right, so maybe this will excite you a little bit more. If I look at the S&P 500, most names in the index are actually higher today. 363 to the upside, 138 losing ground, and Shanali 2 unchanged.
I want to look at some of the sectors as well, what's been moving under the surface. We, of course, had very little red today on a green day. We've had healthcare, communication services, and information technology lower on the day. But we did have a firm bid in energy and consumer discretionary. These have been laggards on the year generally. But, of course, resuming that bid now, real estate as well, utilities, these have become the real rotation trades of the moment, Carol.
Yeah, I'm already thinking Christmas with that chart. That's the only thing I can do when I look at the colors there. All right, let's go to some of the individual. It's just around the corner.
I know. I was like, you want to shop right now, don't you? Is that what's happening in your brain?
I kind of do. All right, let's get to some of the individual gainers. Tesla, guys, check it out. It's the #1 gainer in the S&P 500, top in also the NASDAQ 100, one of the biggest gainers there. So up 5% in the trade. Shares reaching their highest level in about 2 months. Barclays coming out, analysts saying that they expect third quarter deliveries to top consensus estimates, which could drive continued stock strength. So we definitely saw outperformance in Tesla today. Intel, I'm sure you guys have talked about it. I know we did. It's a top gainer in the NASDAQ 100. Apollo Global Management said to be offering a multi-billion-dollar investment in Intel, according to those familiar. And then you still have, remember, late Friday before the close, a report from the Wall Street Journal saying that maybe Qualcomm was interested in a potential takeover. So Intel continuing to be, it seems, certainly an interested target, or at least interested by some other folks. And Intel shares up about 3.3%. So we'll see where that one goes. And here's for something a little bit different. It's a biotech, Biohaven, up about 14%. It's a $4.2 billion market cap. It's experimental drugs slowing the progress of a rare nerve disease in a study, which the company will use to seek U.S. approval later this year. So, Stephen, we saw investors moving into that one.
Yeah, we did. And look, hey, I've got the flip side of your Intel story. I've got Qualcomm for you as well. Shares down 1.7%, 1.75% there at the close. So obviously the fact that Apollo's getting interested in Intel means that if you're thinking about what Qualcomm might do, investors shying away a little bit from that one. Looking at the comments from Melius analyst Ben Wrightsey's there talking about acquiring Intel would be a mouthful for Qualcomm, and Qualcomm made a living as a fabulous chip innovator with a pretty simple story. So this would be moving into a much more complex world if they were to move in on Intel. Of course, antitrust concerns around that deal as well, which is something that should be very interesting to keep a focus on. Elsewhere, I'm looking at General Motors as well. Shares there down 1.7% at the close. We had seen Bernstein cut the recommendation on the automaker market from outperform. I'll get there in the end, saying the data suggests there could be rising earnings.
For all of us.
We're all mundane. We're mundane hard
today.
It's like
10 o'clock where he's from right now.
Yeah, exactly. Right. Yeah, I've been awake for about 3 days. We'll figure it out eventually. We had that news over the weekend as well about GM starting to temporary layoff of 2/3 of the workers, the Fairfax factory in Kansas as well. That's as they begin production of the new Chevrolet Bolt models. That's one other share that we've been looking at too. And American Airlines, which was down a little bit earlier, but just towards the close has managed to rally slightly, finishing down 0.3% as well. We've been talking about the Boeing news around the union deal there, and actually American Airlines one of the transport unions there looking for contract approval for a contract extension, which would be double-digit raises for workers at American Airlines. This would be fleet service workers, ground mechanics, and other personnel. Remember, American Airlines did deal with flight attendants just a couple of weeks ago, getting raises of as much as 20% at a cost of $4.2 billion. So that's in focus there as well. American Airlines down 0.3 at the close.
And of course, we're watching Boeing and how conversations are going on there. All right, guys, quick mention here. S&P closes a record, 40th record high this year. Let's say that again. 40th record high this year.
Stunning.
On absolutely no news.
It's just for me. That's fine.
It's just for you. I was actually looking. I was like, when was the FTSE's last record high? Because it feels like this is not something that you would talk about every day, Stephen Carroll.
I mean, the thing is that I'm practically gone to bed by the time the FTSE closes. But yeah, look, the FTSE was not having a great year. It has a better few months now since the election. But yeah, it's true that we're a bit far away from this 40 records.
Yeah, just a little bit. All right, we were looking at the bond market there. It's just worth touching on really quickly. Not a lot happened, but that curve continues to steepen, guys. It was really about the front end. Now maybe it's about the back end selling off a little bit, and we get $183 billion worth of supply coming on over the next 3 days. So that'll be interesting to see the takedown. But that's gone pretty well so far.
I can't believe the 40th record in the S&P. Sorry, that just seems like a lot. Wow. All right, so let's get to something that we've all probably been measured at some point for our BMI, our body mass index, which is a relationship of our height and weight. And it's often used to say, are we healthy? Do we have a healthy weight? Are we overweight? Are we obese? Kind of put us into a clarification, if you will, or classification. Well, the Wall Street Journal out with a story, and doctors are looking at it and apparently saying that it's flawed. They say it doesn't distinguish between a couple of different types of fat, and it doesn't identify where the fat is located. And Stephen, all of this is really important to really figure out if you're going to have health problems going forward.
But also, it's key to whether or not you get access to GLP-1 drugs as well. So this is something that's a very market-moving story as well. I mean, BMI originated in the 1800s. So, I mean, you could do with an update, I'd say, it'd be fair to say as well. And look, many doctors have been out there talking about how there are better measurements that you can use things like, you know, a ratio of waist to hip circumference is one way that could be used as an alternative as well. There's better calculations for metabolic health as well. Essentially, this was designed with a European man in mind. So as a result, it is very much out of date when looking at a global world.
It's what happens when you start in the 1800s, right? It's almost like some measurement.
Wait, so, but if we go by this, does that mean that America's like more overweight or less underweight?
Well, they'd have to decide how they're going to measure by it instead, and that, I think that'll be the question for next.
Well, I think it's interesting also because you have the testimonials that you're hearing from the GLP drug maker here. And I think what's interesting about this also, this is kind of wonky, but if you think about what's going on in the drug industry, you have to think about how to pay for it, what the costs are, and what the insurance looks like. And this all comes with the overlay of that FTC crackdown on pharmacy benefit managers. Now, they're looking at insulin, but of course, you have to wonder how the rollover applies to GLP-1 over time. And I do think that the definitions ultimately play in at the end of the day, doesn't it?
You stunned us to silence because that was so smart for 406. Let's go to the other chat, shall we?
Okay, we shall.
Because this is Shonali's favorite, and she's the guest host, so let's do that to her right now. So apparently, the old Goldman Sachs building down on Wall Street was converted into apartments, and you can get one for like $4,000. And I find this so interesting because there was, I think, in like a clock tower somewhere in Brooklyn. I desperately wanted to live there, but it was 3 bedrooms and no windows. And my husband's like, you cannot buy an apartment with no windows.
Well, he's right, first of all.
Yes, he was right. Just don't tell him I said that.
You would be so depressed. But also, you really have to go to lengths to refurbish these buildings, don't you guys?
Yeah, it can be really tough, right? We talk about this all the time, right? What you have to do for office buildings. Although I'm looking at pictures and I'm like, sign me up because it looks
good.
Well,
and is there nostalgia value?
You put a pool on the top of a building and like you're golden, like number one.
South Street Seaport is getting very cool. There's like a concert venue down there. So the whole area is being refurbished, let alone finally apartments. $4,000 a month in New York these days.
Well, unless it's like a studio. But you know what's interesting? I think it's like the width of the building. So the fatter your building is, the harder it is to convert because then you're like left with all this dead space. But if it's a skinnier building where some of those old buildings down there are, perfect for conversion.
Like, what do you do with the trading floor, right? Like, you know, we talk about open concept, love it, but that's really open concept.
That's your gym. And your, you know, lounge, concierge, baby stroller thingamajig.
Sounds like you're interested. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody, you are listening to Bloomberg Business Week. I'm Carol Master along with Stephen Carroll in for Tim Stenivek. This week, Stephen, of course, host of Bloomberg Daybreak Europe, but really nice to have you here in New York, and I'm just curious, do you talk about AI as much as we do?
Oh yeah, it's everywhere.
It is, right?
And I mean, look, it's also the question of every person that has a new idea or a new use for it makes you start to think then, well, what part of our lives are not going to be touched by AI?
Well, I love it when people say that AI is going to be a long time before like we really get impacted in terms of society, because I'm waiting for the AI anchors to come into the broadcast. It's going to happen. It's going to happen.
Yeah.
But it's also, it sounds like coming for lawyers.
Yeah, well, look, for many, it's already arrived. The legal industry is one that can see multiple consequences from the arrival of AI. So in one way, first of all, it's an extremely legally complex field. So the arrival of AI into a lot of industries is going to create a lot of work for lawyers. But there are other huge opportunities to revolutionize the way in which a sector which, you know, sometimes has been thought about it being a bit old-fashioned could change, and could change pretty dramatically. So to talk about this, we've got Eleanor Lightbody with us. She's CEO at Luminance, which has developed a legal large language model and recently raised $40 million as it expands into the Dallas market. Eleanor, great to have you with us on the program today. Can you, first of all, just explain to us, how does your technology work? Is this Lawyer GPT?
Not quite. So look, I'm sitting here in New York at the moment, and I'm looking outside a window, and there are people in every building, pretty much in every corner of this world, who are receiving contracts, they're reviewing them, they're processing them, and they're deciding what to do with them. As that stands, it's very time-consuming, it's very manual, it's very expensive, and it can introduce a lot of risk. And so what Luminance is doing is that we're automating a lot of those low-level tasks that pretty much every business is faced with on a daily basis. But it's much broader than, well, I suppose it's much more specific than just a chat GPT wrapper. I think that's really, really important. We built a proprietary, purpose-built large language model that was only trained on legal contracts. And that's really, really key, because if you were using something like ChatGPT to address problems in legal, I suppose because it's being trained across the whole internet, I mean, it's amazing, isn't it? Like creating a contract or writing a poem for you. But fundamentally, it's been trained to give you an answer at all costs. And when you're working in the legal environment, you need an AI that knows when to hand back the answer to the human and knows when it doesn't know the answer. And that's really what sets us apart.
I'm curious, has it been put to work yet?
Yes, absolutely.
So tell us how it's working out, and any snags or problems, and how you continue to tweak it.
Yeah, absolutely. So look, we have over 700 customers now around the world. And in the US alone, in the last 18 months, our US customers have increased by 225%, with the likes of AMD all the way through to Panda Express and Hitachi all using us. And I think fundamentally, how are business using us and why are businesses using AI for legal? Well, they're all faced with the same problem. They're all faced with exploding inboxes they're trying to get through. They're all faced with increasing regulations. They're all faced with having to answer business questions on a second-by-second basis. So they're looking at AI to help them automate and augment that pretty much end-to-end. And what does that look like in practice? Well, that's, I suppose, AI being used for the creation of contracts, AI being used to help accelerate the process in negotiating contracts. So instantaneously, if someone receives a contract with our AI, they can press a button and the AI will tell them what clauses they can agree to, which ones they can't, what the risk is, and what language they should use instead. And then AI being able to answer any business questions of all of their contracts, which a great example would be Yokogawa used to spend about 7 days answering business questions. That's now reduced down to 15 minutes at a maximum. So really that end-to-end nature is how businesses of all different sizes are really using the AI. You asked what are some of the limitations. Well, look, at the moment, the way that the AI has been built, it's really to automate those low-value, repetitive tasks. It's not to do the complex reasoning, and it's not to do the complex advice. But fundamentally, if you can free up people's time so that they've got more space to focus on that, then that's absolutely amazing.
I'm wondering, are there areas of law which lend themselves to using your technology with the clients that you're working with? Do you find there's specific sectors where this really works well, or perhaps others where there's still development to be done before it can be applied?
I think this is it's a universal. It's kind of reaching companies universally in the sense that most companies in the world are having to review very similar contracts. Let's think about your NDAs, your sales agreements, your DPAs, and fundamentally, all those companies want to accelerate the work that they're doing with those contracts. They want to get through them faster so they can really focus on other things. And so that's really where AI can help businesses. That and the fact that it can really highlight key business obligations of what you've agreed to in the past, identify key information instantaneously. That's really, what I think is super powerful. If you're using AI to help you negotiate your multi-million-pound deal, you might use it to help you summarize the key information in that contract, but you're probably going to want to spend more time on it than just, relying on it to do all of the work.
I'm curious. Your company started in a Cambridge dorm room back in 2015. So that's almost 10 years ago. So you guys were doing this sort of thing way before we all started talking about large language models, right? And generative AI. So help us understand kind of what you were doing, how the last year and a half in terms of a whole different level of AI has maybe changed the game, if at all, or impacted you.
Yeah, so it's been unbelievably exciting over the last 2 years. Our ARR has grown 5x, and I think let's cast our minds back to 2015 when Adam and Graham, who are the founders, started the business. They started it in the Innovation Park at the University of Cambridge, and they started it because they had noticed that a lot of their friends were lawyers, and they were commenting on the hours that were being put in and sunk into very similar work. And Adam and Graham were like, look, AI is going to change the way in which humans interact with data and with content. I think we should build something for this. And really, they sold first to law firms because they wanted to get data, because they knew that any AI company that was addressing this problem, data was absolutely key. And so they spent years working with the law firms, and then they kind of moved into the in-house legal teams because fundamentally they realized that the AI worked across all different industries. So it hasn't, I suppose we've been doing AI before it was cool, and the changes and the developments in the models is great because you can combine them with some of the other forms of kind of working and distilling down a contract. And so the combination of what we call analytical AI and then generative AI really allows us to set ourselves apart in this market.
I wonder what your view is on how lawyers need to be trained differently to be able to take advantage of having your tools as well. People invest a lot of money in going to law school, particularly in this country, and I wonder, does it need to be overhauled to fit into an AI world?
Well, I think lots of people spend a lot of money going to law school, not to review NDAs and not to review very similar contracts.
For the junior lawyers, right?
Exactly. They're probably quite pleased that the AI can help them with that and get that off of their desk. I think, look, what we're seeing is AI is being used really to help them accelerate their training. So a lot of our companies will use it so that their paralegals or their first year's associates can get access and insights into how other people within the organization have negotiated different contracts. It's fantastic at retaining institutional knowledge. So I think that that's what we're going to start to see more of, is that whether that's in the classroom or whether that's in real life, people will start adopting AI to help accelerate whether it's their work or whether it's their knowledge, because really that's key to the success of their profession.
Makes me wonder too if it cuts down on those hourly, costs that lawyers charge, because it's like, hey, I just, threw it in the AI model.
More high value work, I think, is at the part of it as well. It'd be interesting as well. Eleanor, great to talk to you. Thanks for joining us. Eleanor Lightbody there, CEO at Luminance, joining us as discussing legal large language models, not Lawyer GPT.
No.
That's what we learned.
Not yet. When we come back, we're going to get into what Doc Martens, North Face, and Oscar de la Renta all have in common. There is a commonality. That's coming up next on Bloomberg Business Week.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Records for both the Dow Jones Industrial Average and the S&P 500 index. Stocks eked out gains, but nonetheless new highs, with the S&P up 16, up 0.3% to 57.18. The Dow up 61, up by 0.1%. The Dow now at 42,124, while NASDAQ was up 26, a gain of 0.1%. 10-year at 3.74%, with a 2-year that's yielding 3.58%. Gold up 0.2%, 26.27 the ounce, and West Texas Intermediate crude slumped 0.6%, 70.52 a barrel. Boeing has sweetened a contract offer for about 33,000 workers at its main Seattle area manufacturing hub, seeking to overcome a strike that has been going on for more than a week and threatens to deepen the plane maker's financial crisis. It was an update for Boeing shares today, advancing by about 0.2%. Again, recapping, stocks higher, S&P up 16, up 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks, Charlie. We're continuing our coverage of Climate Week in New York. We've got that and the UN General Assembly happening as well. But we're thinking about some of the businesses that are using new technology in ways which help the planet. This ahead of our big broadcast we have tomorrow as well, the Earthshot Innovation Prize Summit happening in the Plaza Hotel here in New York. And we'll be there thinking about some of those innovation and solutions that can help in the climate world too. So we want to talk about one company operating in this space. Archive uses its tech to help big fashion brands launch their own resale sites. They're working with the likes of Dr. Martens, North Face, and Oscar de la Renta. Emily Gittins is with us. She's co-founder and CEO of Archive, and she joins us from Berkeley in California. Emily, great to have you with us on the program. Why do brands want to be associated with second-hand versions of their clothes? This is something that I've been trying to get my head around when trying to understand. I know it's a big thing. I know people use websites to resell clothes all the time, but getting the brands involved is a really interesting development.
Absolutely, yeah. Thanks for having me on the show. So, this is a huge market already. The global secondhand market is a $230 billion market today. And for Gen Z, 40% of their clothing is secondhand. And so brands are realizing that there is this huge market for their product that is happening today, mostly on third-party marketplaces. And they're really interested in owning not only that customer experience, but also that revenue stream and helping shift to a more sustainable business model as well. And so there are some of the reasons that brands are getting involved.
So explain that relationship, working with them, and what is kind of the business model, the profitability for you guys, also what they get out of it.
Absolutely. Yeah. So how this works is we build software and tools that allow brands to launch a resale business and then grow it to be, a significant portion of their overall business. So that means you could go onto the NorthFace.com, North Face's e-commerce site, and actually buy secondhand products through the brand, facilitated through our software. For brands, originally this was really for sustainability reasons that they were getting into this, trying to reduce their overall footprint by encouraging more secondhand shopping and less new production. But what they've learned is that actually this is just a totally new revenue stream for them. And the margin on that revenue stream can be quite high, sometimes even higher than on their full price business. And so really they're thinking about it as a business case and a new growth part of their business that is very fast growing and profitable.
So you guys are business to business, correct?
That's right. Yeah, we're the behind the scenes software provider that is facilitating the software for brands to launch their own resale business, and brands can brand that however they want. So we have, New Balance Reconsidered or North Face Renewed, Doc Martens Rewear, just some examples of the brands we're working with today.
I wonder, is it how the conversation goes with some of the brands, though? Because if we're thinking about, the Oscar de la Rentas of this world, is the prestige brand, is that a very different conversation you're having with them when you're saying, look, I know that everything you make is unique and amazing and brilliant, but there's also a market for it to be resold?
That's right. Yeah, I think with the luxury sector, this is much more about highlighting the history, the heritage, the vintage pieces of their brand and owning that customer experience that customers are too often today having in maybe thrift stores or vintage stores, but not directly through the brand. It's a little bit of a different conversation for the more mass brands. That's part of it. Sometimes we'll auction off really interesting North Face products from collections from long ago. But it's also a new acquisition channel for them, right? You know, for a lot of these brands, people are priced out of full price product and maybe buying lower quality items from a different brand. Being able to give them this discounted product in a way that, you know, still represents the quality and the excitement around the brand is a really powerful reason for them to do it as well.
Emily, I'm wondering if the brands that you guys are working with, as you mentioned Oscar de la Renta, Doc Martens, North Face, are they realizing too that the resale customer is different from the customer who buys things that are brand new?
That's exactly right. Yeah. So over 50% of the customers who are shopping resale through our brand partners are completely new to the brand and have never shopped with them before. So it's really reaching that person that is priced out of full price product and bringing them into the brand, you know, having them fall in love with the product and then over time stay within that ecosystem for the brand. And even for the customers that are already brand customers, they generally see a higher lifetime value for that cohort. So people are more excited about the brand when they have this resale option. They know they can resell full price product if it doesn't work out. And so they're shopping across new and used with higher lifetime value as well.
Is it a generational story as well? You know, is it Gen Z being influenced by thrifting brands on TikTok that's, you know, got them into the idea of owning, you know, secondhand clothes?
Absolutely, yeah. I mean, Gen Z are obsessed with thrifting. They're obsessed with secondhand and not buying stuff new. It's, like I said, it's 40% of their closet. So a really big part of how they're shopping today is already secondhand, and brands want to have a piece of that. But interestingly, we have actually seen it across all generations where for some of our brands, the customers getting involved with this are a lot older. But the fact that they can do this through the brand, they can go back and maybe resell and buy pre-loved items through a brand that they know and trust versus a marketplace is compelling them to start for the first time, which is exciting to see too.
It made me wonder about something like The Real Real or something like that. What does this kind of cut into their business? I mean, it has to, I guess, ultimately, right? Or I don't know. What are you hearing?
Yeah, I mean, this is a very fast-growing market. Secondhand is gonna grow by 100 billion in the next 4 years. So there's a lot of opportunity out there, and I think the way I think about it is when I'm buying new product, sometimes I like to go to a retailer and buy across a lot of brands. Sometimes I like to go direct to a brand and just buy directly through them. And so we see the secondhand market evolving in a similar way, where there's always going to be a place for cross-brand marketplaces like The Real Real or Vinted. Right. But also brands will want to own that direct piece of the business as well.
I love vintage. I'm curious, do you shop vintage?
I've only started recently, actually. So this is something that is a new world to me. And, you know, in London, I have a great range of charity shops that I shop from. But I feel like that this is elevated to a different level. But Emily, I had a question around the idea of, is this also a quality control issue for the brands? That they can make sure that the versions of their products that are out there are of a certain quality because they've at least had a touch with the process of resale?
Absolutely. Yeah. Authentication, especially in the luxury sector, is a huge risk for brands, and they're seeing knockoffs on other marketplaces. And so one of the reasons to take this in-house is to control that whole process, and we can put in place a lot more authentication measures because we're partnering directly with the brand than what's possible otherwise. So yeah, it's a really good point. And glad to hear that you're buying more secondhand as well.
Yeah, exactly. I think we all are, right? I kind of love it. I have to say, I also like the idea. I do think about the environmental impact, right? Because we talk about the fashion industry so often and the impact it has, you know, whether it's making a pair of jeans, but even much more broadly about kind of disposable fashion, right? Fast fashion and the impact it has on the environment. So I do think it's a smart thing for people to be doing. Talk to us a little bit, we are Bloomberg, talk to us a little bit more about your growth numbers because they sound pretty dramatic, but give us an idea. You've been doing this for a bit. Are you profitable? What's the growth plans here?
Yeah, we're seeing a huge amount of growth. We've been around for 3 or 4 years. We're, you know, still a startup, but now working with 50 global brands, including the likes of, you know, New Balance, the North Face, Doc Martens, these brands that really want this to be a large proportion of their business. And so with that, we're seeing our business grow really significantly year on year and a lot more appetite. I think what's been exciting is, you know, maybe 3 years ago, we were going out and talking to brands about why they should do this. And now they're coming to us knowing that this is going to be such a big part of their growth going forward.
Where do you see the growth path coming from? Is it going to be those higher end brands? Who are you getting the most interest from?
Yeah, I would say it's everything from kind of the mass of the market up to the luxury brands across, honestly, a range of different categories. We have a lot of success with kids brands, with accessories like handbags, outdoor brands, women's wear, menswear, and even starting to have conversations outside of fashion too, which is a really interesting thing as we think about the other categories out there too.
Yeah, I think about the kids marketplace, it's kind of interesting. I'll say at Bloomberg, there's like almost an internal marketplace, like somebody.
Oh, well, I feel like that's everywhere.
It is, right? Especially because when they're little, right? Because
Yeah.
you barely use something and then someone's like, okay, here, you got to take this. Like, it's brand new. Please, like, make use of it.
Yeah, no, I mean, look, and it kind of opens up a whole other world as well. Outside of fashion, where else would you be thinking of going?
Yeah, I mean, home brands, kids gear, right? Not just the clothing, but think about all of the things you buy when you have kids and that can be put back into use. Electronics, gear like bikes and skis, things like that. I think that the world is our oyster. And I think just to touch on your sustainability piece, Carol, the fashion industry alone contributes 8% of global greenhouse gas emissions, which is 3x air travel. When you think about adding kind of home and all of the consumption that we do for all types of products, that is a huge impact that we're having from producing new stuff. And a lot of times the right product exists, it's just in someone else's hands today. So how do we make it easier for consumers to match up there?
Yeah, it totally makes sense, and it certainly is something that's on consumers, a lot more consumers' minds when they go to do shopping. What's next for you guys, though? Do you stay? Capital raises, stay private for a little bit longer? What's your thinking in that front?
Yeah, we'll stay private for a little bit longer. Likely raise some more capital at some point. And I think just continue to grow. Look, we're having a lot of success in the US in particular with the fashion industry, but thinking about international expansion, category expansion, and expanding our product to ultimately serve brands better and allow them to grow this into a more significant portion of their business.
What would be your next key international market?
Oh, I'm from the UK, so that's a big one for us. A lot of demand from the UK and the rest of Europe. Honestly, we're seeing a lot of consumer behavior change and policy change over in Europe. So countries like in Scandinavia, Germany, France, really far ahead of this trend on a lot of fronts. So I think we'll be there soon.
Very cool stuff. And I do think it's really so much more of a way people are shopping increasingly. I've done it like for a wedding, you can really tap into some great brands, some great things at a much reduced cost.
Yeah, indeed. Emily, thanks so much for joining us. Emily Gittins, their co-founder and CEO of Archive, speaking to us from Berkeley in California. I think the high-end part of this is the really interesting growth area. If you were able to access luxury brands in a way that's affordable, and it can build from the company's point of view, it makes sense as well because it can build that brand loyalty that might turn into when someone moves up an income bracket, they might then be able to afford something new,
Absolutely, especially if it's like the first time you're buying something, right? And you're like, okay, I kind of like this, so let me buy another.
Do you remember your first designer handbag, Carol Masser?
I might. Or it might have been gifted.
Yeah, also good.
Which is
also
awesome, which is really killer. All right, when we come back, Steve and I continue. We are going to get into something, I teased it a little bit earlier, but it is something that impacts a lot of families and millions of people around the world. That's coming up on the other side of the break.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We had a record-setting day for both the Dow and the S&P 500 index. Stocks managed to eke out a gain, but records nonetheless. S&P now stands at 57.18, up 16 today, up by about 0.3%. The Dow was up 61, up by about 0.1%. Nasdaq up 26, higher by 0.1%. Stocks advanced as traders sifted through commentary from Fed policymakers and saw scope for further easing after last week's half-point rate cut. 10-year at 3.74%, the 2-year 3.58%. Spot gold up $5 the ounce, 26.27, up by 0.2%, while West Texas Intermediate crude oil was down 0.5%, 70.63 for a barrel of WTI. Well, lots of economic data this week. Veronica Willis is global investment strategist at Wells Fargo Investment Institute, and she was a guest right here on Bloomberg Business Week.
I think ahead, we've got some important data this week. Most importantly, we've got that PCE inflation expected on Friday. And while, markets have shifted their focus a little bit to the labor market over inflation, I do think that those inflation updates are going to continue to be important.
Veronica Willis of Wells Fargo Investment Institute. So again, turned out to be a mixed day for the Dow, or actually an up day for the Dow, the S&P, and Nasdaq, a record for both the Dow and the S&P 500 index. Constellation Energy is leading power companies higher today, led power companies higher after its deal with Microsoft was well received by analysts. Constellation Energy extended gains from last week. Morgan Stanley raised the target on the biggest American operator of nuclear reactors after the company said it would invest $1.6 billion to revive its 3 Mile Island plant. Today we had shares of Constellation up 0.8%, Microsoft down by 0.4%. Recapping, S&P up 16, up 0.3. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now or wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Carol Master, along with Stephen Carroll, here on Bloomberg Business Week. Stephen in for Tim. He's normally host of Bloomberg Daybreak Asia.
Europe.
Oh, why do I keep doing that?
I don't know. I mean, I could do both. That's fine.
You could do probably all of it. You know what? You normally do a tease of Bloomberg Daybreak Asia, like at the end of our show. So forgive me.
I'm just
it's like
everywhere.
a default.
Yeah, I'm everything everywhere all at once.
Bloomberg Daybreak Europe.
Thank you.
You're very welcome. Told you it was a Monday.
Look, well, actually, do you know what? This kind of speaks to what we're going to talk about next, because we're going to delve into a big global issue as well that we're going to be talking about. We've mentioned that it's Climate Week here in New York as well, but it's also World Alzheimer's Month, and World Alzheimer's Day was on the 21st of September as well. And of course, the real aim of that event is to try and raise awareness about this illness that just is affecting so many people all over the world.
Yeah, it's about 55 million people that are believed to be living with Alzheimer's disease or other dementias. In the U.S. alone, we're talking about almost 7 million people, and that includes about 200,000 people under the age of 65 with what they call younger onset Alzheimer's. So let's get to it, because I do feel like when we talk about the medical world or healthcare or treatments, that this is one of the things that a lot of companies, drug companies in particular, are working on to find a better way to treat it, find it, cure it, if you will, kind of one of those holy grails. So on that, we welcome Dr. Alicia Algeciras-Simic, professor of laboratory medicine and pathology at the Mayo Clinic, with us from Rochester, Minnesota. Doctor, it's great to have you here with Stephen and myself. First of all, give us an idea of kind of where we are in terms of Alzheimer's. We threw out some numbers, but it does sound like, are we seeing more younger individuals getting it? Tell us what we are seeing on a global scale.
Yes, what we're seeing is an increased number of individuals that are being diagnosed with Alzheimer's disease, in part because of the newer diagnostic options that are available, as well as the availability now of disease therapies to treat the disease and slow down the progression of the symptoms. So that availability of therapies now has increased the need for diagnostic testing.
Can you explain to us the importance of early diagnosis and how that feeds into then somebody's both care that they need, but also how it affects the evolution of the disease?
Yes, absolutely. The early diagnosis is critical for patients presenting with symptoms of cognitive decline, because the earlier that we can diagnose the patient with Alzheimer's disease, the earlier and the more timely the therapies will be. And the therapies that are available today are meant to be used in patients where when the symptoms are still mild, because that's when they are more effective in slowing down the progression of those symptoms. And even in individuals that might not be eligible for the newer therapies, having an early diagnosis can help with lifestyle changes that might still benefit and improve their quality of life for a longer time.
Can you give us some examples of what those lifestyle changes are? I think this is just an issue that so many of our listeners will be thinking about. This is something that is affecting, I think, all of us, it's fair to say. So what changes in how one's lifestyle might shift if you did have an early diagnosis?
Yes, absolutely. You know, there are a number of modifiable lifestyle changes that has been described: diet, exercise, smoking. These are all different areas that can be approached to modify and improve their health.
So tell us about the tests that you guys have developed. What do we need to know, and is it put into effect yet or put into use?
Yes, absolutely. So the test that we developed, it measures one of the early changes that happen in the brain of patients with Alzheimer's disease. And this change is the accumulation of a protein named or called beta amyloid. And this protein accumulates and forms plaque in the brain that eventually leads to the symptoms the patients develop. The test that we offer, which is called p-tau217, is a blood test that allows for the detection of those, the accumulation of that beta amyloid protein in the brain.
And how widespread is that testing being available? How quickly can it be made available to a wider number of people?
Yes, actually, it is available to any provider around the world can order this test through Mayo Clinic Laboratories. And we do require that a provider actually order the test. So this is not a test that can be ordered by patients. And we also need to keep in mind that these tests at this time have been optimized to detect Alzheimer's, to diagnose Alzheimer's disease in patients with symptoms. So it is very important that it is performed in patients presenting with symptoms of cognitive decline. But any provider can order that on their patient.
What kind of symptoms? Because as you said, it's important to catch all of this early in order for a better outcome. So what kind of symptoms are likely so that a patient knows to go to their doctor and maybe ask about it?
Yes, so in general, you know, there are symptoms of mild, what we refer as mild cognitive impairment, so maybe some forgetfulness and some memory loss and such. But what happens is that when these patients will go to the provider, they will do a battery of tests to look at their cognitive performance, whether they can recall some objects or names and various cognitive testing, which then can determine whether they have mild cognitive impairment. And those are the ones that will benefit the most from these tests at this time.
What sort of interest are you getting? What sort of demand is there for this test from providers? And is it from the US alone, or is it more global?
No, we receive samples from around the world, actually, and there has been great interest. We are surpassing the test volumes that we have originally predicted. So there is a lot of excitement for the test because there is a need to be able to have a non-invasive test that can help diagnose patients.
Just real quickly, 10 seconds, is it covered by insurance typically?
Yes, it is covered by insurance, but the amount that is reimbursed, it depends on the insurer provider.
Is it an expensive test, real quickly?
It's not. It's cheaper than other modalities that are available today, such as the PET, which involve looking for amyloid protein in the brain, or the CSF, or the spinal fluid testing.
Dr. Alicia Algeciras-Simic, thank you so much. When we come back, we're going to dig a little bit into the music industry and what it needs to do. That's next.
This is Bloomberg Business Week with Carol Massar and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody. Carol Massar along with Stephen Carroll, who's making fun of me because it's like, is that how you tease here in New York?
As I've told you several times, I'm just happy to be here.
We're so happy to have you.
But I have very little idea what's going on, I think is what we've learned.
This is a hard, you're totally on it, but it's like, it's a tricky show. There's a lot of moving parts and like, you look for those rhythms and sometimes you're like, wait, why or what?
But look, I'm really excited about our next conversation because I really am fascinated by where the entertainment industry goes from here. We've gone through, I lived through the Napster era, all of the different various versions of the internet getting into music.
Do you have laser discs? Did you ever have laser discs in movies?
No.
Okay.
No, sorry. I did not. But anyway, let's talk about the music industry in particular,
yes.
and something that caught our producer Paul Brennan's attention as well, streaming 2.0. Let's talk about what's going on at Universal Music with the details. Ashley Carman and the latest from her Soundbite newsletter with us from New York. Ashley, great to have you on. So look, talk us through, what is streaming 2.0?
Yeah, so last week, Universal Music Group hosted basically an investor day where they talked about the vision for the future for Universal moving forward. And essentially what they put out there was this idea of streaming 2.0, which instead of focusing on subscriber growth as a whole, will focus on ARPU. And also this idea of monetizing super fans, really doing commerce, selling merch to fans, getting really involved in kind of these microtransactions that add up to money.
So what is that? Okay, so what does it mean specifically? So what is it when you talk about merch? Are we talking T-shirts? What are we talking?
Yeah, it could be T-shirts. I mean, one group that has really done this well is a K-pop group called BTS. They have an app that they use to talk to fans. It's one way they forge a super fan connection. So the idea is really maybe there's exclusive content, maybe there's exclusive chats with the artists. So that part of it could really be, it's not fully developed yet, but it's this idea of merch, really fan experiences, things like that.
Yeah, I mean, it's almost like bringing Cameo to music artists more specifically, that people would be able to use that to get individual messages as well. Is essentially what they're trying to do is create Taylor Swift-esque fan connections for every major artist who will want to buy the merch and have greater interaction with artists as well.
They really want to see artists as a brand, a universe in which you can live. So that could be they have a gaming partnership and they show up in Fortnite or wherever, Minecraft, something like that. They do a concert there. You see them on social media. You are consuming their plot lines there. You're wearing the same clothes as them. I mean, we've seen with Beyonce, just as an example, she really made Chrome part of her brand over this past couple years with her Renaissance album. Olivia Rodrigo has shown off the color purple, so people wear purple to her concerts. It's sort of a branding exercise almost.
What's this going to cost we consumers? When I look at more and more tiers, I'm so tired of paying all these monthlies, but tell me where this goes.
Yeah, so as far as the streaming 2.0 and the actual streaming part of this, like I mentioned, they really want to increase the amount they make on individual users. So instead of, a catch-all premium tier, we know Spotify is working on something called Super Premium or a Super Premium tier. We don't know exactly how much it's going to cost yet, but it's supposed to be rolling out this year. It will include high fidelity audio, and then we sort of don't know what else they're going to offer, but it will be more expensive. And the idea is that you'll upgrade to get some sort of exclusive access to something.
But surely the stable of artists for which this can work, that people are willing to pay the extra premium for, is quite limited. Does Universal think this is something that's going to be able to become a much bigger part of their business?
I think as far as the streaming 2.0 and the actual level of people who subscribe to more premium tiers, I do think they see a strong opportunity there. And that affects the whole pie from which all artists are paid. So the revenue is larger, the whole pie is larger, they can get a larger chunk of it potentially. As far as...
Oh, no, go ahead, go ahead. No, continue, please.
As far as artists who maybe can really draw fans to pay extra for various things, I don't know if they see it as for every artist, but Universal, at least during this Capital Markets Day, really positions itself as we are the home for superstars like Taylor Swift, like The Weeknd, who people will pay for access.
It's interesting. I was watching a piece on Pearl Jam over the weekend. It was on one of the morning programs, and they basically said, because we don't sell albums, we don't sell CDs anymore. Like we've got to look, you know, it's all about like kind of going on tour. Like that's where the big money is at this point. And you do think about what Universal's thinking is how do we figure out some other revenue streams for these artists and also for those of us who are, you know, working with those artists to create the content.
Exactly. And for what it's worth, Universal's not involved in the live side of an artist's business. So they really are looking for those merch opportunities and those streaming opportunities and other just ways to monetize fandom.
Is this going to undercut some of the social networks as well, though? If they're getting, you know, if artists are going to be getting into dealing more directly via their record labels with their audiences?
It's a good question. I mean, obviously the social platforms are wide reach, wide scale. You can reach billions of users with the tap of a button. These apps are probably going to be more niche if they are developed. And any way they go direct will probably have to rely in some part on social networks or the streaming platforms.